Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name is Lukasz and I'm pleased to be joined today by Maroun Younes, Co-Portfolio Manager for our Global Future Leaders Fund. Welcome, Maroun.
Thanks, Lukasz. Thanks for having me.
Look, it's been a very interesting market environment, and one of the big topics at the moment, which a lot of people are thinking about, is this sort of paradox where quality companies have been underperforming. And quality has been a strategy that's been very successful over the last 40 years. But it's causing a lot of frustration at the moment. Give us a snapshot of what's been happening in terms of performance of quality companies.
Yeah, you're right. Quality has been underperforming for quite some time now. I was playing around with the data. Going back 40 years, it looks like we are now in probably the second worst period of quality underperformance. Just to give you some background, during the run-up to the GFC, so it was a raging hot bull market. Over the course of about 3.5, almost 4 years, quality underperformed the broader market universe by a cumulative 40% over that 3.5-year period. What we've seen so far since about mid-2024, we've seen quality underperform the broader market universe by about 30%, and that's been going on for, coming up to 2 years now. I've also identified a number of prior episodes in that last 40 years where quality underperformed by 10% or more. Prior to this last episode, there was 9 previous episodes. Mm-hmm. On average, the magnitude of underperformance is about 15-16%. Mm-hmm. And the duration is about 11 months. Mm-hmm. We are now 21 months into this quality underperformance cycle, and it's 30%. So it's twice the magnitude and almost twice the duration of a typical quality underperformance cycle, and the second worst that I've been able to find in the last 40 years. Mm-hmm. So it is quite a severe underperformance period for quality investing.
And if we think about quality, I mean, for your average punter out there, there's an assumption that, well, of course you invest in quality stocks. But when we think about quality from an investment perspective, what do we actually mean? Because, who doesn't invest in quality? What do we mean by quality?
Quality investing in and of itself faces this dilemma because there is no universally accepted definition of what constitutes a quality company. So, different academics over the years have produced different papers and they've used different factors. Some are focused on things like profitability metrics, margins, returns, the, volatility of the earnings profile. Some have used things like shareholder payout ratios, balance sheets. So it really is quite a nebulous term. For MSCI, who produced the MSCI Quality Index as well as the MSCI World Index, the 3 factors they've sort of settled on when assessing quality is return on equity. Mm-hmm. It is the predictability or the volatility of the earnings profile, and it's a debt-to-equity ratio. So under MSCI definitions, higher quality businesses will have higher returns. They'll have less variability of earnings, and they'll have better balance sheets. Now, the last point I was going to say is who doesn't invest in quality? What constitutes a quality business doesn't always necessarily constitute a quality investment. Or a good business doesn't always equal a good investment, because that last piece there that you always need to apply is valuations. Yeah. So sometimes quality or just investing in the highest quality businesses you can find with total disregard for valuations can lead to substandard outcomes. So it's always important to look at quality, but always, in the context of the valuation multiples as well.
Right. And so if you were sort of to position that in layman's language in terms of quality, because it does seem like there's a variety of ways to describe it, would it be fair to say that you're really looking at companies that have resilience? If you think about a company with strong balance sheets, factors like that, it's sort of resilience comes to my mind.
Exactly. Resilience, durability, being able to withstand different macroeconomic shocks, recessions, pandemic lockdowns, wars, rising interest rate environments, all those sorts of curveballs that the global marketplace throws at you, increasing competition, those sorts of things, being able to be strong enough and solid enough in your footing to be able to withstand, a lot of different forces, effectively is what you could conceptually think of as a quality business.
So you mentioned at the beginning of our discussion that Quality's had a rough period in recent years in terms of performance. But if we look at the long-term data, it does suggest that Quality is actually a quite powerful indicator of potential future returns. So paint a picture. Why does Quality work over the long term?
Yeah, so you're absolutely right. Quality, again, going back to the last 40 years, if you looked at the MSCI World Quality Index versus the MSCI Broader World Index, on an annualized basis, Quality is outperformed the broader universe by about 3% per annum. Now, that initially may not sound like a huge amount, but you've got to remember the power of compounding.
Yeah.
So over a 40-year period, the additional 3% per annum return has meant that if you'd invested $100 in the Quality Index back in 1986 and $100 in the broader world index back in 1986, and you rolled forward 40 years to today, you would have 3 times the amount of money in that quality universe than what you would in the broader market universe. So 3% per annum compounded over a long period of time leads to extraordinarily different outcomes. So Quality has outperformed over an incredibly long period of time. Number one disciple of quality investing would be Warren Buffett, who was always advocated, buying businesses with strong economic moats, competitive advantages, pricing power, those sorts of things. So why does it work? It tends to outperform the most in drawdown environments. Recessions, periods where the economy is weak, periods where the equity market is very weak, Quality tends to fall by a lot less than the broader universe. So if you cast your mind back to March of 2020, it was a very deep but very short-lived drawdown. Quality outperformed quite substantially. Throughout the GFC, Quality outperformed. When the dot-com bubble burst back in 2001, 2002, that bear market there that lasted all the way through to 2003, Quality outperformed quite substantially. All those sorts of painful environments for investors, Quality is what allows you to outperform in those environments. So not only does over the long term Quality outperform, it also gives you better returns with less variability because those painful episodes are still, painful, but not as bad as extreme as investing in, random or the broader market.
Yeah, and it's a really good point because, particularly in periods where the market is delivering very strong returns, we do forget on that part of the equation, the volatility equation.
Yep.
And it gives us a little bit of a clue as to the recent environment. So, if you think about the recent environment, Quality has underperformed by a material margin in recent years, albeit over the long term we know it outperforms. But what's some of the drivers in that recent period of the underperformance? Why has Quality lagged the broader market?
Yeah. So if you look back historically at periods where Quality has lagged the broader market, you can basically group them into 2 buckets. I mentioned Quality outperforms in recessionary periods or deep market contractions. Following a recessionary period or a deep market contraction, what you normally get is that early phase expansion, where the economy stops getting worse and starts to get better. That initial wave, and it could last 6, 9, 12 months, however long it is, Quality underperforms. What usually outperforms the most in that environment usually is a lot of junk.
Yeah.
Now, why is that the case? Because in recessionary periods and bear markets, junk gets hit the hardest. So it's fallen the most. It's the most sensitive. So either, margins are very low or it could be loss-making. The balance sheet is incredibly stressed. So any tiny improvement if your margins go from 1% to 2%, that's a doubling of your profits. Whereas if you're a high quality business and you're still producing 20% margins, even in a recessionary period, going from 20% to 21 or 22 or 23% margins isn't, the same magnitude of improvement. So Jung tends to lead on the way out in recovery periods. Other points in time where quality is lagged has been what we call melt up, where the market goes strongly upwards. And that is usually because investor sentiment comes on quite strongly. It's a very risk-on environment. And in that period, what you want is exposure to stocks with higher beta. And quality, because of its defensive characteristics, tends to have lower beta. So actually, what helps quality in market drawdowns becomes a bit of a drag or a lagging factor in those periods of very sharp risk-on appetite. So back to your question, what has transpired over the last, I guess, almost 2 years? A couple of different things. Firstly, you've had we haven't had a recession, but if you sort of remember 22, 23, the market was quite soft, inflation was quite high, interest rates were quite high, and then subsequently we've had those things come down. Now, particularly in places like the US, we've had the PMI, which is a survey of manufacturing activity, be sub 50 for a long period of time. Now, sub 50 means you're in contraction mode. So we've had economic indicators for a sustained period of time that were more in line with the recessionary periods, but we weren't in a recession. What we started to see from about late 2024 onwards is those PMI numbers start to pick up, akin to a expansionary period. So you've had activity levels or indicators of activity levels pick up. You've had things like Trump's One Big Beautiful Bill come into pass, tax cuts, trying to bring manufacturing back onshore into the US. That stimulated a lot of activity in the US. We've also seen a huge AI capex boom, and everyone is spending a huge amount of money on AI. So and that's also brought about an increase in risk-on appetite and investor sentiment. So you've actually seen a bit of both. You've seen almost indicators of an sorry, the other thing I should mention is you had that tariff drawdown in April of last year, but again, that was very short-lived because, a week or two later, Trump said, look, all these can, basically subject to change. We want to negotiate with different countries around the world. Those tariff levels can come down, and the market breathed a sigh of relief. So you've almost had like a mini recession without a recession. You've had activity levels improve, or indicators of activity levels improve, akin to an early cycle expansion. And then you've had extreme investor sentiment and risk appetite in certain pockets of the market, particularly those exposed to AI, which is very also akin to a melt-up scenario. So you've had basically a bit of both combined together over the last year and a half, almost 2 years. And that has meant that quality stocks that do better in contractionary periods or when there's macroeconomic uncertainty get left behind because there's shinier, more exciting things to chase after.
Yeah,
that's effectively it.
Yeah, so there is that real sort of fear of missing out environment, which and that exuberance, which we have definitely seen. So if we sort of reflect on where we are today, I mean, you've been in this business for a long time, looking at companies, all types of companies. Do you feel like we've sort of seen the worst of it from a quality perspective in terms of where we are in performance of that broader quality cohort?
I think we've probably seen the worst. It's always hard to tell in real time. But again, if I sort of go back to that historical data, twice the magnitude and duration of a typical quality underperformance period and the second worst on record. So just simply looking at history, odds would say we're closer to the end of that underperformance cycle than anything else. And then if you look at the environments where quality does well in, quality does well when there's a lot of uncertainty, when growth, is still positive but starts to come back down again. So late cycle, basically, where the economy is still growing, but it's not growing at 4, 5, 6%. It's growing at 2, 2.5%, and it could be a little bit choppy. So we're seeing indicators of growth around the world slowing down. We're seeing a lot of macroeconomic uncertainty, particularly now with the conflict in the Middle East. That's pushing up oil prices. That's having a lot of potential impact on margins for various different businesses, because oil or energy is a big input for a lot of different businesses. So manufacturing businesses, transport, those sorts of things, margins in those sorts of industries. If we see a prolonged period of high energy prices, we're going to see pressure on those industry groups in terms of margins. So the macroeconomic picture is becoming a little bit murkier. It's becoming a little bit, less rosy. The euphoria of high growth and everything's looking great is subsiding. This tends to coincide with periods of where quality starts to actually rise to the top.
Yeah. So, I mean, I think it's interesting because whenever you get these extended periods of any part of the market underperforming, you do get this natural capitulation where people have said, well, I can't, hold on any longer. But
yes.
I guess the message here is that quality does go through cycles.
Yes.
And we've been in a sort of elongated cycle where quality's underperformed, and it's maybe not the right time to capitulate at this point in time.
Absolutely.
Yeah.
I mean, if you think about quality, it underperforms, again, going back to the last 40 years, it's underperformed on average about a third of the time. So periods of underperformance, they're not uncommon. They're actually a natural part of the journey. Think of it as, I guess, the cost of entry or the price you pay if you want to access market-beating returns over the long term. It's not free. There's a price to pay. That price to pay is effectively you have to go through periods of underperformance, roughly about 1/3 of the time. So over a 10-year period, there'll be 3 years there where quality underperforms the broader market. But you got to keep your eye on the prize, and it's all about the long-term picture. And capitulating towards the bottom is one of the fastest ways to destroy value. You definitely don't want to be doing that at the wrong point in time.
Yeah, absolutely. There's some good advice there in terms of just having that long-term investment horizon in mind when thinking about any investment, particularly around quality, which is definitely a long-term investment strategy. So if we sort of look ahead and maybe you can talk a little bit about your outlook, and in particular, you do manage a global mid-cap portfolio, which over the long term has generated very strong growth. But if you look ahead and you do have that bias to quality within that portfolio, how do you see the next sort of 12 months and where are you focused on in terms of your portfolio?
Yeah, so I guess I alluded to that, not that long ago, but we are seeing an increase in the uncertainty levels, particularly around the macroeconomic environment with oil prices. So we have some oil exposure, some energy exposure in the fund, which has done incredibly well over the past month. That's holding up quite well. We're staying away from businesses that are, where energy is a large input cost. Because I think their margins will be pressured over the next sort of year or two. These sorts of periods where, particularly a supply shock in something like energy, even if you had a ceasefire, the markets don't immediately resolve themselves. So it's hard to see how, even if we had a permanent ceasefire or a permanent solution tomorrow, how oil could go back to its pre-war levels, before the end of the year. So we are going to get, at least another 7, 8, 9 months of elevated, at least relative to pre-war levels, elevated energy levels. And if your business relies on energy as a large input cost and you're not hedged, for example, that means your margins are going to come under quite a bit of pressure. So we definitely don't want to be leaning into businesses like that. So think of things like airlines and cruise liners and those sorts of types of businesses that don't have pricing power. And with the increasing uncertainty, you certainly want businesses that have the ability to generate consistent profit margins, consistent returns, irrespective of the macroeconomic environment. So definitely you don't want to be leaning more and more into cyclically exposed businesses that require a pickup in economic activity. At the same time, we also have a high level of conviction in the capex build-out profile for at least the next 2 years. Our analysts have been doing quite a bit of work around that around the world about the sustainability of that AI capex boom. And so we do have a number of businesses that are leveraged to that, and we've been adding to positions, over the past 12 months into those sorts of things. So it's quality, but at the same time, businesses that can really make the most of this, once in a generation capex boom, which is, exclusively in the sort of AI data center domain.
Excellent. Well, Maroun, thank you very much. I think the key message is that quality over the long term can contribute to very strong performance, albeit it will have periods of underperformance, which we've experienced at the moment. But the message is to stay the course, because over the long term, quality has outperformed.
Absolutely. I think you summed it up nicely there.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only, as being prepared without taking into account any person's objectives, financial situation or need. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.